Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Rupee. Now, a lot of you have been writing into us, sending us queries on China. And most of you have noticed the rebound in that market, which is leading a lot of investors to wonder if they should take exposure to the Chinese market. Suddenly there are queries on China-specific funds, whatnot. So we decided to do a proper classroom on global investing, make it a little more holistic, because it's not about trying to play a trading bounce in market A or market B or owning one fancy stock versus the other. It's about looking at your portfolio more holistically. Do global equity markets make sense for Indian investors? And if yes, what are the routes through which you can access them? What are the things to keep in mind? And what are the risks you should always consider before taking that investment call? Today, to answer those questions, I have with me Chintan Haria of ICICI Prudential AMC, as well as Mohit CEO and co-founder at Moneyfront.in. Gentlemen, thank you so much for joining in. And I can already see some of the Diwali festivities behind Mohit, so I think it's that time of the year. But, really, we wanted to start off, Chintan and Mohit, with broader thoughts. Like I said, the trigger for this conversation is obviously this 30% rise in China and then, 10% fall in China that we've seen. People, sit up and take notice of these things, and then they wonder, oh, how can I participate in this rally? So, opening thoughts, Chintan.
So yes, I mean, India is only about 4% of the global market, and the rest 96% is outside. So US has been one of the largest in terms of the global market space. China has caught attention now. It caught attention in 2016 as well. And I think way back in 2017-18, when Brazil did well, Indian markets were about 10-15%. Brazil was up about 100%. That also got noticed, and there was a local Brazil fund which got a lot of inflows. So international investing has its own charm, and I think with people now focusing on asset allocation, we at ICICI have always been speaking about asset allocation. Yeah. 10 to 15% asset allocation in international does make sense, but then international is again another completely different ball game with so many countries involved. Japan did very well in the last 2 years as well. Yeah. So there are so many moving parts, much like how in equities you'll have moving parts, you'll have sectors moving. Similarly, international. So you need obviously professional guidance, and then you need to know exactly how to do it. But yes, today it is reasonably easy to get access. Some of the limits are shut right now, I'm aware. But yes, people should have about 10 to 15% outside, but they need to know exactly how to do it. And that's where the tough part comes.
So that's where we have the two of you to help out our viewers. Mohit, let's get in your thoughts when people come to you with, the need to make a fresh allocation. Would global markets be on your radar?
Absolutely, Surabhi. First of all, to you and to all your viewers, very happy festive season ahead. And yes, look, I think India has been a fantastic story for last 2-3 odd years, and for in fact many years now. But my sense is, if you were to just look at some small data points, and one data point through which I'd like to open is that on a 1 year, 3 year, 5 year, 10 year, 15 year scale, right? All these time scales, if you were to compare Indian markets with, let's say, an US market, an S&P versus a Nifty, S&P has beaten Nifty on all these time frames, right? So here comes the thought, along with what Chintan Bhai said, that India is a very small component of global market cap, right? So if you want a truly diversified portfolio, if you really want to hedge against some bit of sovereign risk or hedge against whatever Indian markets or hedge against the volatility which you can perhaps counter in Indian markets, then the right way for an investor is to have a diversified portfolio across global themes. Basically, maybe 10 to 20% of the portfolio into international markets, either directly or through mutual funds. But yes, it's absolutely warranted.
Okay, fair enough. So the operating part of this is you should know exactly where to invest and how to invest in a very cost-effective and safe way, right? Now, as our guests have pointed out, there are two routes through which you can access global markets. One is by going direct, buying stocks directly, and the second is through the Indian mutual fund route. So, Mohit, I want to start with the former first, because there are a lot of local brokers now that seem to have tie-up with global brokers, and they're offering you access to a lot of global equities. But how does it work? And is it primarily for the US market, or can you also access markets like Chintan said, Japan, China, and a lot of these other major names?
So I think anything and everything is now accessible to Indian investors. There are many platforms which have come up. To my mind, I think Interactive Brokers is one of the largest players globally to buy anything, whether you want to buy ETFs, you want to buy direct stocks, you want to buy bonds, or you just simply want to trade global currencies. you can do through that platform. It's fairly simple, and it's a global platform, and it gives you access to almost every single country in the globe. Right? But the only thing which investors need to know is that it is all done through the LRS route, which is the liberalized remittance scheme, which is monitored by the RBI. So every investor, every financial year has a cap of 250,000 USD, under which he can invest into any of the global markets, right? So beyond that amount, you can't invest abroad. So similar to interactive brokers, there are platforms like Stockall, Vested, which gives you access, but they give you access to niche markets. To my mind, I think interactive brokers is one platform which is universally acceptable and gives you access to almost all markets.
Okay, so thematically that sounds great, but now the technicalities come in, Mohit, because I might be a regular retail investor. I only have 50,000 to invest or 1 lakh rupees to invest. So then what about basic minimum entry threshold barrier limits? What about cost? How do I convert currency? Take us through step by step.
Okay, so look, these are fairly expensive mechanisms. Honestly, these are not for retail investors. My two bits will be that if you are a retail investor, you're looking at smaller ticket sizes and you don't want to send your money overseas, right? When you use the liberalized remittance scheme, it is akin to you sending your money outside of India, or it is akin to you converting your money into dollars or into the underlying base currency of the country where you're investing in, and then investing. So there is a conversion cost. There are the platform charges. There are the broking charges, right? So the charges are pretty hefty, and one has to be absolutely cognizant that whatever underlying theme might be, he or she is absolutely confident that those charges perhaps are nominal to the overall extent of gains which the investor is looking at. But my two bit will be, if you are not an institutional or an HNI investor, then perhaps these are not the right ways of investing. I would still suggest that you have to then go through a mutual fund route, which is much more convenient, much more democratized in the sense that the ticket sizes are fairly affordable and the liquidity is absolutely simple. The charges are minimalistic, right? And you know the management, you have some recourse if you really want to access the fund house folks. You can go ahead, speak with the representatives, and you can understand the underlying theme and everything, right? So my sense is for retail investors, the direct platform or the direct route requires a lot of research, a lot of due diligence. One has to be cognizant of the charges. These are not easy mechanisms. And you have to do a lot of reporting to RBI for the funds which you're sending abroad. And once, if you want to get it back, then the taxability becomes a big factor. So all those are pretty tricky issues to tackle with, right? So it's not for retail investors. Unless you are a HNI and you want to send your funds abroad, or you have some ultimate usage abroad for the funds, that's when you choose these methods and try and go abroad through the direct platforms. Otherwise, I think MF route remains the best one.
Oh, okay. So it's thumbs up for mutual funds, Indian mutual funds, even if you want to go overseas. Take your points and concerns on board, Mohit. So Chintan, come in on this. And some of the comparisons that Mohit was drawing, right, that the charges would be a lot higher if you're going through a broker directly, even if it is an Indian broker linked to a global broker. I mean, typically, how do those charges compare, let's say, with a MF expense ratio, a global fund expense ratio?
So global fund expense ratios, much like local funds, are regulated. There are caps of 2.25% depending on what route it is. If it's a passive fund, then 1% is the cap. And within that overall 1%, the entire expenses, etc., are managed. Besides the expenses, of course, like Mohit bhai mentioned, retail investor will have limited bandwidth to understand which sector, which segment, when NASDAQ or when, let's say, Japan or when US. Let the experts do it. So we mutual funds are trying our best to do it. Currently, if we look at it, because of the $7 billion limit, I mean, of the 60 lakh crore plus mutual fund AUM that is there, only about 60,000 crores or less is there in international funds because of the limit. So it's less than 1%. So it's not meaningful in the context of the overall mutual fund industry. But yes, it is meaningful from an absolute point. But the costs, etc., much like how we manage the active funds on the Indian side, etc., we try to break it as less as possible for the investors, be it the currency conversion costs when we remit, etc. So the point is, at lowest cost, the management of the funds investing in the right manner so that investors get the right exposure. And that's where when we thought of it in the last 10, 15 years, we not only had, let's say, a US fund or a NASDAQ or a global stable fund, we also brought in fund of funds where we could make the shifts. in the mutual fund, which help investors to participate. Currently, they are all shut, of course, because of the limit.
Yeah.
But our idea was to provide solutions to investors, and through the fund of fund route, that basically is something.
I actually want to understand the difference and the different routes, but just to complete the point on direct global stock investing, the charges that you mentioned, Mohit, I mean, ballpark, rough, range across different brokers, what would it be? And we're talking about maybe a brokerage fee, a currency conversion charge that you pay to the bank. So let's say you want to at least make a 8, 9, 10% return equity, because it's equity that you're playing. And on top of that, typically, how much can the charges be?
To be honestly, I'll not have an exact extent, but my sense is the currency conversion can go up to honestly 50 to 70 bips in extreme cases when the ticket sizes are very small and very retail. Right, and then you will have brokerage charges and platform fees and other charges, which could be as high as around 2% and it can go even higher from that perspective. So if when you club all these together, it's a fairly expensive mechanism. Though I will not have an exact breakup of the fee which each individual platform charges, and plus it will also varies from currency to currency and country to country. So if you're investing in US market, perhaps it might be cheaper because dollar is a fairly widely accepted currency and best used, right? So, but if you go into exotic markets, let's say if you were to invest in a Brazil market or even per se Chinese market, right? And if you want to pick direct stocks or pick up an index directly, then it might be a fairly expensive proposition.
Absolutely. Okay, I think you've driven the point home really well that for retail investors who are not dealing with very large pools of money, mutual funds remain the best route through which we can take exposure to global stocks. So what we'll do is we'll take a break on that note. When we come back, we dive into the mutual fund route full throttle. A lot of funds are shut. Why are they shut? What is their structure? How do you sort of navigate this? What are your options today if you want to take global exposure through Indian mutual funds? We discuss this after the break.
Let's Talk Money.
Welcome back. You're with us on this week's edition of Let's Talk Money, and we're talking about going global with our investments, that is, and the different options that you have. And our experts have, reached the agreement that it's much better to look at global equity markets through Indian mutual funds rather than trying to do it on a piecemeal basis individually by trying and buying international stocks sitting here in India because of the various charges and the complexities involved. So, Chintan, now let's come down to the issues at hand, the limits that you spoke of, the fact that a lot of global funds, Indian funds that invest in global markets, they're simply not taking money.
Yes.
What is this limit issue?
So I think almost all are shut right now because there was originally a limit of $7 billion for funds which are investing outside. $7 billion, which funds which are investing outside, that's about 60,000 crores. And there's a separate limit for $1 billion if you're investing in ETFs outside. I think that's the basic limits. And those limits were set 15 years or so back because obviously India has to conserve its foreign exchange reserves as well. And there was a quota that are there. We hope that these limits eventually open up, and when Rupee appreciates and as we become a $8-10 trillion economy, definitely this should open up. Hopefully, before we become an $8-10 trillion economy, it will open up. But currently, these limits are regulatory limits, and hence most of the mutual funds which were accepting money earlier are shut for subscription right now for investors to invest outside.
So when you talk about the whole universe of global funds which are operating here in India, are most of them fund of fund structures that simply go and invest in other funds or ETFs, international funds or ETFs? There's something called the feeder fund route. And are there any Indian asset managers who are actually buying and choosing stocks directly, global stocks directly? Do we also have those kind of funds?
Yes, so we have all the options. So typically, as far as US is concerned, for example, we have a fund which invests outside. So we pick and choose based on our research. Then there are funds which are investing in funds outside as well. So that's the feeder fund of fund, wherein someone else, some other asset management fund company is managing the fund, and we are just basically feeding into that fund.
Okay.
So both options are available. And then there are passive funds as well. So these are active side.
Correct.
And then on the passive side, you basically invest in a index fund outside or an ETF outside, or you have a fund here which is mimicking an index.
Like the NASDAQ. We have a lot of products
where
on the NASDAQ.
we basically are actually, like our NASDAQ index fund is actually picking the stocks of the NASDAQ and investing in those stocks outside.
Sure.
So it's not a feeder.
So and I've always wondered, from an investor standpoint, what would be, in an ideal world, when these funds were accepting money, what would be the best combination or the best route? I mean, it's very easy to understand. If you're bullish on US technology, you'll go and take a passive product,
Yes.
a NASDAQ-based ETF product. But what else? I mean, how should you look at your investments?
So currently, as we look at it, there are different options available. For country-specific also are available, like Hang Seng and Nikkei, and China also. US, of course, is the predominant one because it forms 60% of the global market cap. But as far as investors is concerned, much like how you choose sectors, because sectors are cyclical, even countries have cycles, right? Japan from 1990 to 2019 was probably not doing much. And from 2019 to 2024 recovered most of the pain that it was there. And similarly, other countries have ups and downs. So as far as investors are concerned, I think they'll do well to not, one, follow the past performance, because that generally leads to investors investing in a late cycle where they then get hurt. And we saw that happen in Brazil, for example. Brazil for the last 4-5 years has not done much. But before that, it had moved, like I said, 100%. Similarly, maybe even US tech, etc., which, like Mohit bhai mentioned, has done very well for the last 15 years. But that's not necessary that it may do well in the future, because valuations also catch up. So as far as investors are concerned, that's where we felt that, having a fund of fund, which is taking bits and pieces or an allocation to all of these available funds, is something which would be fruitful for investors, where we are making the choice and they are not. And that's where there's one more option available as and when they open. That's called the Global Advantage Fund of Fund. That's essentially a fund which we are running, where we are allocating to these international funds based on our research. So that investors don't have to make the choice. We are making it easier for them.
Okay. All right. Fair enough. So that kind of explains the choices that we have. Now, Mohit, let's talk China, because I know that you're actually a little optimistic on this market. And, like Chintan is saying, that past performance is no guarantee of future returns. He cited Brazil's example. But I know that you're still willing to take a bullish call on China. The market's yo-yoing. It's going everywhere. But if you do want a part of the China equity action, then what route would you follow? What kind of funds would you invest in?
So there are three ways to my mind from the mutual fund route, and there are a couple of other options on the ETF side. The three quick ones on the mutual fund side are Edelweiss Greater China Fund. It's actually a JP Morgan fund managed by JP Morgan, which gives you exposure to all three: China, Taiwan, and Hong Kong markets. To my mind, this is one of the best options to invest, right? The second one is Axis Greater China Fund, which is again a good option to invest in. And the third one, which is not exactly China, is a Mirai Hang Seng Tech ETF FOF. Right, so it's just tech on the Hang Seng index, but not pure play China. So the first two ones are the pure play China funds, which are available to Indian investors through a mutual fund route.
Okay, fair enough. So those are some options that people can work with in case they're really convinced on the China call. But gentlemen, we also have to now talk about currency, which plays a huge part, because unlike, investing here locally, where we just have to bother about how good a company is, how efficient a stock is, in international investing, we have to look at currency appreciation or depreciation very, very carefully. So, Chintan, what are the tips here? And again, I say, because you'd want, the market to give you 10% return, and then you have to account for all kinds of currency risk. So what are the factors that one needs to keep in mind?
So, Surbhi, when you're looking at investing internationally, of course, the dollar return matters to us. And let's take the example of Japan to make it easier for investors. Japan, for example, may have gone up 100%. But the Japanese currency has depreciated by about 30% in the last, say, 2 years or so. In that case, the return is 70% and not 100, right? So you need to take care of currency. In the case of India, for example, you invested in US 10 years back when rupee dollar was, say, 55. And today rupee dollar is 84. So not only the return that you got from the US investments doing well, the currency depreciation also has added to your returns.
For a foreign investor who chose India.
For an Indian investor who is investing abroad. So for, say, Indian investors who invested, let's say, in US 10 years back, and US, along with India, has been the best performing market globally. So whatever return you got, add the currency return, because rupee depreciation from 55 to 84. In the last 10, 12 years has added to your return over and above what US markets give. So dollar returns have been good. And then if you convert it into rupee, it adds to your returns.
So would it be, right to say in a simple fashion that if you're thinking of investing overseas, try and invest in a market where the home currency is going to be a very strong currency vis-a-vis the Indian rupee? Would that be a...
So rupee depreciation helps you when you are, or rupee coming down from, say, 80 to 84, helps you when you're investing outside. But if rupee goes from 84 to 80, and mind you, that could be the case if India is going to become the stronger part and world's third largest economy, there is, much like how we've seen in Japan from 1970 to 1990 and China from 1995 to 2015. Now it's said that 2013-14 to 2034 is India's 2 decades. Rupee may actually have an appreciative bias also.
Sure.
So for those investing outside, Rupee going up from 84 to 80 may reduce your international investing returns if Rupee is going to appreciate. You need to keep that in mind if you are a believer that Rupee may appreciate.
Wow. So there's a lot of volatility beyond just the stock movement that you have to consider on the currency front as well. But, what are the average returns? If we talk about a longer time horizon, at least 5 to 10 years, then with all of this currency fluctuation volatility, typically China, I mean, what is the return that these funds have generated in the past? Again, only for reference, not to project them in the future. But Mohit, let's talk China and the US, because these are the 2 key markets, right?
The first choice or first door of reckoning for anyone would be a US market. And my sense is, I think a US market typically would be in the similar range as an Indian market. Plus, as Chintan bhai mentioned, if you are in the camp which believes that Rupee will continue to depreciate against the dollar, last 20-year trajectory of Rupee has been 3.5% depreciation, annualized depreciation against the dollar. So if that were to continue, then it would add on to your underlying returns. But if Rupee were to appreciate, obviously you have to take that off from the table. But my sense is 12 to 15% should be your range of expectation if you're going primarily in the US market. And then otherwise, if you're going in any other market, so it's very difficult to predict because the underlying volatility of each market could be fairly high.
You're going to China, Mohit. Mohit, you're going to China. So what is your return expectation, say, over the next 3 years?
My sense is I'm expecting a higher double-digit kind of return from the Chinese markets, given the cheap valuations at which it is quoting. And my bet is that the government and the central bank out there is pushing a lot for the economy to come back on track. And all said and done, a $19 trillion GDP economy, which is a global growth engine, commodity guzzler, will have to swing back into action for the global growth to pick up.
Sure. Okay. Well, we're almost out of time, Chintan. So final thoughts. And we haven't touched on one wonderful silver lining, which is taxation, right?
Yes.
Because after this budget, the July 24 budget, taxation on global funds, international funds, has become very, very favorable. Now, I think the definition of long term is only 24 months. You hold for 24 months and the tax is 12.5%. So does that apply to even funds, whether you're investing in Japan, China, Greater China?
Yes. So the July budget beautifully clarified and removed any confusion whatsoever. Any international fund of fund or index fund or fund of fund that you are investing, for example, outside, if you're holding for more than 2 years, it will classify for long-term capital gains tax and the 12.5% bracket. If it is for less than 2 years, much like any other fund of fund, it will be taxed at 20%, which is a short-term capital gains tax. So this has been the tax clarity has also made it more, let's say, good for the investors to get into the international funds as and when they open, and we hope the limits are opened soon so that the investors can take advantage. Having said that, just to add, I know limitation of time, US markets and Indian markets valuations-wise are same. Indian growth rate is 6-7%. US markets is only about 1.5-2% real growth. So one is probably decelerating, the other is accelerating. So I still believe that the large investors or the large investment money being in India is good. There will be tactical plays internationally, but I think India is where the next decade is.
Okay, well, we like the sound of that. And as you said, from a tactical point of view, to add a little bit of color to the portfolio, if you want to go to US or Japan or China, now you know the options. Gentlemen, thank you very much. This has been a helpful conversation. Thanks for joining in and answering all of those queries. Well, with that, it's a wrap on this edition of Let's Talk Money. Do keep sending us your comments, feedback, questions. We'll see you again next week.
Let's Talk Money